Let's hope that we are in for a better Wednesday after a rather scary Tuesday. And will it be a better Wednesday? Well, so far the breadth has improved. Good news. The breadth has improved. Then now let's look at Z. I'm just going to look at stocks purely based on price action, not so much so in terms of news action, because that's where you want to look at. Now look at the market and look at the casualties in the market. Wherever there is bad news, that stock is simply getting knocked like a sledgehammer. HDFC Bank is down, Z is bouncing back. IRCTC, IRFC, RVNL, all these stocks are down anywhere between 2 to 3%, and the downward spiral I think has started. Vodafone is the only odd one out from the mid-cap rank, mid-cap space, which I can point out is looking decent, but it's not looking like a great space there as well. Karnataka Bank, numbers were not that great, and there is a simple way in which markets just move these days. When numbers are not strong, they hammer you out of shape, and that's what's happening with Karnataka Bank. After a couple of quarters upbeat, when growth slows down, the stock gets just jammed. So banks, they continue to be on the receiving end. That I think is the problem. Today, minor jump here, minor jump there is visible, a Pidilite, a Indus Tower, but rest of the market in terms of the heartbeat, if I may say so, the heartbeat is not very clear. Railway stocks, Asha, up, down, that price action has started. It's crazy in nature. But frankly, look at Karnataka Bank, another casualty, mid-cap bank, but a casualty nevertheless in terms of result reaction.
Yeah, absolutely. In the meantime, just want to see what some of the other names are up to. Karnataka Bank, of course, is seeing relentless selling. I want to see what JSW Energy as well is up to, because the results were marginally soft versus what the street was anticipating. And remember, JSW Energy has been quite a highly HNI concentrated name. You're not really seeing much of a fall here, still staying put behind this name. Pidilite, the consumer business volume growth has come in above estimates, so look out for what that does. 3.5% of a jump coming in. Again, a very high HNI concentration stock. There's Indus Towers, which came out with its numbers. MGL, wherein the Q3 was above estimates. There's L&T Finance, wherein the NIMs have come in at an all-time high of about 8.9%. Asset quality also has improved, on a sequential basis. L&T Finance will just come up for you on your screens. But yeah, the mood across the private banking names, that really continues to be soured. Axis Bank, irrespective of an inline set of numbers, the deposit growth, remember, for them has come in excess of 5% sequentially, best amongst the private banking peers, but still the stock is down 4.5%. Kunal, what's the fate of private banks firstly?
I think the trend continues for the private sector stocks, and I think that's where we've been advising a lot of caution that not to venture into these stocks because they are cheap by 5%, 7%, 10%. You have to wait out for a point where the stability comes back into these names. Just to give you a data, the open interest jump in HDFC Bank is almost twice in the last 7-8 days of the selling for the stock price. That itself tells you the skew of the market towards these kind of names. In terms of opening trade, Indus Tower is something which I highlighted in the morning and yesterday. Still looks attractive at 217, 218 mark. So that's a stock which I'll look to trade in the open.
Okay, Indus Towers is a buy call, and that's Kunal's view amongst the private banking names. Naresh, your observation, any trend that you're picking up in the market right now, and of course your first trades too.
So in terms of market, what we are seeing is we are very close to the 200-day moving average on the bank Nifty. We've seen majority of the impact come from HDFC Bank. And today we've seen a very large volume take on a gap down today at a 3%, was a pre-open gap down. And we've recovered from those levels. So overall, the view is we are getting into a zone where we can see a sharper recovery from. So in terms of stock, continue like ICICI Bank, which is the new leader. So at 1,020.25, that's a stock which could continue and make a new all-time high.
Okay, ICICI Bank, still bullish on that name. In fact, I want to revisit what ICICI Bank is up to, because HDFC Bank continues with its downward spiral. It's now just about defending that 1,400 price point. ICICI Bank, while this week it's managed to scale up about 2.5%, but it's down about roughly 0.5% or so, but it's still clinging on to that 1,000 rupee per share mark. Axis, of course, is where you're seeing quite a bit of damage. I also want to revisit what IndusInd Bank is up to. Remember, that fell off by a good 6.25% yesterday. IndusInd Bank is seeing just mild resilience today. But again, these are just early rates. Let's see whether these rates sustain or not, and whether these gains hold on or not. Railways, of course, is one pocket where you're seeing a tumble once again. And I say tumble because most of these names are still, falling more than 5% apiece. And I can see dots of red across the power names as well, the financiers, REC, PFC as well. I don't know what IREDA is up to. That stock will just come up for you on your screens as well. PFC, of course, lower by about 0.5%, 3.5% lower now for IREDA as we speak right now. So that's pretty much it in terms of some of the individual movers as we speak right now. But Naresh, just wanted to get your thoughts in on some of the railway names and whether, continuing to short right now is the best strategy.
So in terms of railways, it's become clearly an over-participated sector. So funny part is if you look at IRFC, the number of retail shareholders are 32 lakh plus, which is more than Idea. It is more than a lot of large names like SBI, etc. So out here, it has been over-participation and looks like we have created a major top in a lot of these names and we could see a slow drift. So it remains a sell on rise rather than doing anything else. So I think 2.3 lakh crore market cap for IRFC and a lot of these railway names, very low floats, 5 to 15% floats. Time to actually keep booking profits at any rise. Everything seems to be in the price.
Fair enough. Meantime, Naresh, let's also get in your thoughts then on some of the stocks that are bucking the general trend. And you've got something like a Tata Steel that's holding out quite well, and as well as a Hindalco. What is the trend for some of these metal names?
So I would wait out for the results for most of these metal names. Post that, if they do not react negatively on the results as such or on a sharp reaction on the downside, that's the time you want to buy. Do not want to preempt any moves on the metal side. Mining looks more interesting. So NMDC continues to remain the best bet on dips and even the smaller names on the metal side. And specialty steel on the small cap side, you've seen a Kalyani Steel make a new all-time high. You have a Sunflag Iron, which is doing well. So the focus is to go beyond the large cap steel names, look at mining and the small cap steel names.
Wanted to highlight a few more stocks. Karnataka Bank has taken a sharp knock right now. It's down about 11%. Cyient too is taking a knock of almost 7%. So quite a bit of drubbing there. Cyient, of course, hasn't come out with its numbers yet. Cyient DLM had, and it looked like a decent set. Not really sure of what's happening in Cyient because there was a client-specific issue that they had highlighted a couple of days ago. Not sure if the reaction is coming today on that one. CG Power down about 5%. And of course, on the gaining side, don't lose your focus from Z Entertainment because that stock continues to hold with a gain of around 5%. So a bit of a bounce back. Pidilite is shining bright, and so is REC with a gain of around 4%, given the commentary that we got from the management yesterday, and we'll play out those snippets of the conversation shortly as well. But before that, listen into what Gautam Shah's view is on the market right now and how the technicals of the various sectors are panning out.
See, when you are at levels close to 22,000, I think risk reward plays a very important role in what you do at the markets. And I think at current levels, pharma offers a lot of value. We've seen some lovely trends shape up in the recent past. I mean, look at what Sun Pharma has done. It's just been a nice, clean, steady move up all along. Doesn't have anything to do what the market does. And I think these are the kind of trends that you want to commit yourself in. So pharma, I think as an index continues to look super solid. And I do see another 10% upside for the index. So stocks could give you anywhere between 13 to 20%. Within the pharma space, Sun Pharma, Dr. Reddy's, Divi's Lab and Cipla, which came out with results and it's reacting today, all look super solid on the charts. And I still believe that at these levels also for the market, one should commit into pharma because I think this is a trend that is going to continue for the next couple of quarters. So pharma and IT are actually our favorites in the current market from a risk reward angle.
In IT then, if we were to get stock specific, given that you're talking about it being an outperformer?
Well, yeah, I think our working target for the IT index has been about 39,000. So I think we will get there gradually. Midcap IT has already seen a very smart move in the recent past and continues to run up. I mean, look at stocks like Persistent, Mastech, LTTS, Coforge, emphasis. All of these stocks, I feel, have the potential to go up another 10 to 20%, maybe even more if you have a slightly longer term time frame. And if you look at the large cap IT stocks, I think the kind of rebound.
Okay, got Aman Chauhan as well joining in from Abacus Asset Managers. Aman, hi, morning. Good to have you on the show. Aman, what are we witnessing right now? A bit of a correction in an otherwise intact bull market?
It's profit booking, not just correction. People have made decent money, very strong gains in the last 10 months now. And we'll see rounds of this where it's a herd mentality. If you feel that markets are going to correct 5%, you would like to book profit, then we want to re-enter 5 or 10% lower. So I think it's just one of those phenomena which is just playing out for the last few days.
You know, Aman, but that aside, tell me what's happening within private banking names. Now, HDFC Bank, of course, is a standalone case. One understands that. But the market is punishing inline numbers like an Axis and IndusInd as well.
This is something which is we were surprised the way Axis Bank and the IndusInd Bank corrected yesterday and today because there was no reason per se. And from a valuation standpoint, also financial is one pocket where relatively there's still a decent risk reward equation. I think it's overowned. Maybe too much of ownership. It's liquid names. If somebody wants to book some profits, this is the best way to do it. Maybe these are the technical factors that is leading into it. Otherwise, from a fundamental standpoint, I don't see banking to be in a negative shape for stocks to react so much. So from what we feel, it looks more of technical than a fundamental reason for stocks to correct this way.
So, Aman, what are you doing with your portfolio right now in terms of financials and the other sectors as well? Is it a bit of a churn that you're doing? Because pharma and FMCG seems to be those defenses that people are now flocking to.
Not really. It's not a big churn person. So we continue to like private banks. We continue to be very selective on these large PSU banks. We don't have any small PSU bank exposure with us. And one change you can say that we have added non-fund based financials like wealth management companies into our portfolio in the last month or so. So in fact, overall, we have increased our exposure, but that increase has been more to do with non-funded financials coming in.
You mean the NBFCs of the world, or you're talking about those stock market ancillaries per se, the financial services?
Yeah, broking companies, wealth management companies. So that's why we have increased our exposure.
Aman, hi, morning. Wanted to also get in your thoughts then on the flurry of companies that hit the public markets last year. There were a number of companies as well that made it, and this year there are some big companies as well slated. How have you looked at the overall valuation picture? Any interesting IPOs or recent listings, and the performance of some of these new age tech companies?
Not much. Since we follow a value conscious style of approach, we find most of the IPOs are like priced to perfection. So we are not very active in the IPO space. You can say that we are more active on the QIP. In the last 2 months, there have been lots of placements by the companies where we have participated. So we have been more active in pref and QIPs than on the IPO side.
Aman, I see in your growth fund as well as the emerging opportunities fund, you're very heavily skewed towards industrials. And I'm guessing from industrials, apart from the names like L&T, etc., there might be some, names like railways, defense as well. Talk to us about what you're doing within that space now, because that too is getting very overheated and over-exuberance seems to be seeping in.
True. So defense clearly looks overheated. We don't have much exposure. That will be like low single digit. Same thing with railways. We have exposure, but it's less than 5% of the portfolio. So within the industrials, we have cap goods, we have cement companies, we have that segment where we are very bullish on, and that's where bulk of the investment is. So specifically to defense and railways, I'd say low single digit would be the exposure there. And that exposure is also at prices where we are comfortable. So we are not gone ahead and bought something at a ridiculous price. So happy to hold what we have.
But, Aman, what we are seeing is, of course, railways is just one segment of it. You're seeing profit taking across the PSU pack, be it power, ancillaries, and, I can go on, highlighting the list of the PSUs, and ex-banks is what I'm talking about over here. Do you think that as a cluster was getting a little bit overheated, much like the railways?
Yes, it was. So if stocks double, triple within 2-3 month period, then obviously there has been very sharp gains and people would come in and want to book profits. From an absolute price, I might not feel that the stock is overheated, but if you have already discounted 3-4 years numbers right away within the next last 2 months and the stock is already up to 3x, there is a chance that people will come in and book profit. So the gains have been so huge that even a 10-20% further correction of price profit booking from these levels also, stocks will be still decently priced. So I won't be surprised the way there have been some profit booking. Just been a few days. The stocks have been rallying since almost 9-10 months now. So I don't think one should be get too worried till the time we are with the right company. I think staying put in these names makes sense. Just that in the very near term, it was a very sharp up move, and that's getting corrected.
Aman, what about the outlook when it comes to the liquidity situation, given that we were hinging on support coming in from the foreign institutional investors? Just a few weeks into January and we haven't quite witnessed that. Is there a worry that it might not come through, or are we pretty confident that as the months progress, we will see the FIIs buying in?
We are confident that FI should come in. We also, it's a wait and watch when they start coming in. We also closely monitoring the data. Globally, if you look around, India stands out. It's one of the fastest growing economy. We are not expensive, though we are not cheap, but we are fairly priced. There's no reason why FI money shouldn't come in because they also have lack of other opportunities. They are not investing to China. If you see last year, most of the neighbors had a negative return. Like CY23, China markets had been negative, Thailand was negative, Malaysia was negative. So there's not much of option for FIs also who are investing globally, but to look at India. So I'm pretty confident that FI money should be positive this year also for India, especially once we enter into the election mode and the current government gets re-elected. I think that is also going to be a big boost for the money to come in.
Like that's already in the price, Aman, a continuity of the government.
Bit of it is yes. So it can also. I don't think anybody is waiting for April, May, or June for the election outcome to come in before putting in the money, right? So it's a consensus right now that Modi is getting re-elected, kind of thing, at least in the markets. And yeah, people are positioning ahead of that. So in the next month, I think the positional trade for the election should happen.
Okay, so that's about how the elections are likely to pan out, or at least what the street is factoring in right now. But Aman, I also seen one of your top holdings name like Polycab come into the picture. I know you can't talk stock specific to a great detail, but I just want to understand, how do you approach when an issue like this really crops up? How should the retail investors as well as the institutional investors like you approach this?
So first and foremost is wait for the right data. So right now what we have is nothing official. So there is no notice to the company specifically. And hence one should first understand the gravity of the situation rather than jumping in, because this is a long drawn process. There are always uh, claims and counter claims that keep on coming in. And this is not something which is unique to one or two companies. Every few months there is something like this which keeps on happening. Many times it is genuine, many times it gets nullified. So our advice is the way we approach is till the time there's decent clarity, we don't act.
Till the time you have clarity, don't act in a hurry. But I mean, you also keep on hunting for the turnaround stories, right? Anything specific that's caught your attention?
Not off late as such. There was a time when there were good turnaround in the metal space, but most of them have turned around. From a sectoral standpoint, I think in the next few quarters there will be a turnaround in the chemical space. So this is one sector which is seeing lots of headwinds, both on pricing as well as on margins, both in the bulk as well as in the specialty chemicals. And I think in the next 1 or 2 quarters things should start to bottom out, and this can be a good turnaround sector or opportunity one can look at.
Okay, and what's your view on IT right now, and even pharma for that matter? Are you looking at increasing your exposure there as well?
IT, we continue to stay neutral. So we never went underweight when there was a slowdown. So we always had a decent exposure in IT, which was like high single digits. We continue to maintain that. We have not added any new names per se. We can say we are neutral. Maybe if we get a absolute opportunity in the next 1 or 2 quarters, we'll look at it. Pharma incrementally, we are getting positive. So over the last 6 months, we would have added to a pharma exposure, and looking forward to further increasing that.
In what nature? Is it hospitals and healthcare? Is it diagnostics? Is it the export-oriented names or the domestic ones?
Mostly export-oriented names, because that's where the maximum damage was, and that's where the turnaround or that's where the recovery will be there.
Okay, Aman, great to have you on the show. Thanks as always for taking the time out and chatting with us.
Sure. Thank you.
Okay, that's the word coming in from Aman Chauhan saying that it's routine profit booking that you're seeing in the market. And yes, there were spaces of exuberance, largely the PSU pack, railways, defense names, and that's where you're seeing that profit taking set in. Guess what's a mover today? Z, 6.6% higher, although it's nowhere close to the damage that it did yesterday, wherein it fell more than 30%, but almost a 7% uptick. There's Hindalco, which is holding out by about 3.5% today. Aditya Birla Financials is up about, that stock is up about 3.5%. Pidilite is the other one, which is holding up 3.5% or so. And REC as well, which is higher by 3.5% as we speak. What continues to see profit taking though is banks. So Axis Bank is now down about almost 4%. By the way, Hero MotoCorp as well is lower by about 2%, and this comes just a day after the newest launch, that's Maverick, in the affordable segment. Oberoi Realty as well is down about 4.5%. The numbers missed the street estimates. You saw huge profit taking in Realty, which has been one of the best sectoral performers year to date, or for that matter of the past year as well. And today, too, you're seeing some red built in over there. What is HDFC Bank up to? It's actually recovered from the opening lows, but it's still in the red, a smidge so, about 0.2% lower. ICICI Bank as well is a little bit soft, and I'm talking about the futures rate. In the cash markets, it's already made it back to the green, HDFC Bank that is. And Reliance as well is lying absolutely flat, as is Adani Enterprises. So let's see which way this head from here. But Nikunj had a very exclusive interaction with banking veteran KV Kamath, where he opened up about the Indian banking system, his views, his opinions. Let's hear out an excerpt of that very special chat.
The financial sector, and because things have evolved in the last 2-3 decades, is going to underpin the growth story of India. The Amrit Kal 25-year, and then you need a strong financial sector. You need to look at, go back, Japan, and then the Asian tigers, more recently China. It's now our turn. When the economy starts rolling, this sector provides the momentum to it. So it's a long-term story, at least 5 to 10 years. It continue to be relevant even after that, but there will be other sides of the economy which will take the baton and run thereafter.
Looking at some nuances right now, CASA is the new gold. Some would call it it's the new data, or it's the new Bitcoin. There is a war of liability. So while banks are growing, they have a challenge in terms of maintaining that kind of a pace on deposits. Is that a reasonable concern for the sector per se?
Yeah, I think it is. My view is it is going to be there to stay. To what extent one would have to look at, and banks will need to then figure out how they operate in this new normal. And I'll tell you why I'm saying it's going to be there to stay. The large part of CA earlier on was corporate. Now that has moved to virtually overnight investments elsewhere, which give them a higher return. So one leg of CA is gone. SA basically was the lay saver, where the money stayed in the bank account as savings, and then it got above a particular threshold, it went into a fixed deposit. And then you remember the process. There was a certificate, and then you had to renew the certificate and submit the certificate and so on. Today, in a world which is digitally connected, everything is real time. So the saver has also understood that he has options to put that saving into other instruments at the touch of a button. And as we go on into the next, say, 5 years, even people below the bottom of the below the middle of the pyramid, tending towards the bottom of the pyramid, will be facile in using an app to move money to what they consider to be better investment opportunities. So this is going to provide a challenge to that SA that was saving, that saving account which was sitting in the banks as we go along. So banks will need to really figure out how is it that they're going to compete in this new normal, and what are the sources of funding that they would need to look at. I think they will figure it out in due course as we go along.
So the hallmark of Indian banking sector, at least the private banking sector, has been that they've enjoyed margins which are perhaps highest in the world. That's largely because of the construct of the Indian sector. Do you think high margins, spreads of 3% plus, NIMs of 2.5 to 3%, that's all history now?
See, at least most of my banking career, we worked, at least the bank I worked for, ICSA, worked with margins of well below 3%. Initially because you were a development bank which became a bank and you had to pay extra for all the liabilities you now had to build up, provide SLR and CRR on that and so on and so forth. And later on, nature of business changed. So I think this current high margin and high NIM business is transitionary. It is partly fueled by the high NIMs that we are seeing in the fintech space. But to me, it is transitionary. So what will happen? I think NIMs will have to correct because it should be affordable to the borrower also. So banks will need to now learn to do things in a lean way. Lean in terms of their processes, lean in terms of technology, and try to bring that cost income ratio down significantly. And I would dare say the target I would have set if I were anywhere here is to say, can I operate at a cost income ratio half of what I am now operating at? Because then that will allow me to take NIMs down, be competitive, and pass on the benefit partly to my borrower and partly to my bottom line.
So do you see a reset, sir? Because the competition will intensify. Some banks will be able to pass on costs, some banks will not be able to pass on costs, especially the legacy banks. So then are we looking at repricing of loans? Are we looking at pressure on NIMs going forward in 3 to 5 years?
Yeah, because I don't see an alternative. And life may not be as hard as they believe it is, because it's going to be, because technology is now becoming so agile, and so I would say it provides you comfort that you can actually take the existing technology in a bank and virtually float in a completely new platform at probably 1/10 the cost that you are paying today. Is still not sinking in. The risk is looked at as overwhelming. But as long as 1 or 2 brave banks take that risk and maybe float in new technology for parts of their operations, and that is observed to be successful, then there will be a rush to migrate. Fintechs are already able to do that. So fintechs are not able to make money for other structural reasons, not because their technology cost is high. So I think there has to be a learning from the fintech business, which will seep into the banking and rest of the financial services space, which then will provide this opportunity.
Mr. Kamath, every bank is taking a lot of pride in the retail book. They say retail book is growing, which is more than half of the total book. There are no NPAs there, and they are very careful in terms of using technology and AI to ensure that NPAs don't come. But Reserve Bank of India has a different take on how unsecured loan in the retail book is growing. What is your take?
Long back when we had just started credit card business, and there weren't too many people in the credit card business at that point in time, I was told by either Visa or MasterCard that the fraudster is only at max 3 to 6 months behind you. So whatever algorithms that you have in terms of AI that you use to keep the fraudster out, he's going to very quickly crack it. So you need to be ever vigilant and then have a healthy blend of unsecured and secured lending, which will keep you in good shape. So just now, the caution or the red flag raised by the Reserve Bank in terms of increasing the risk weightage, I think is very appropriate. And that will probably correct things which otherwise could have gotten to a situation where it was not going to be correctable.
A lot of fintechs also, Mr. Kamath, they are in a sense now doing loan syndication. They are borrowing between two individuals, whether it is B2B or B2C, that runs into north of 25% plus. And I wonder that if somebody is borrowing at 25% plus, looking at the cost of the economy, I mean, this is like a time bomb ticking, because it's a matter of time they'll default in servicing the loan.
See, I will look at 3 data points to put in risk, which the regulator probably definitely saw when this call was taken. The fact that large number of borrowers from who are borrowing from the new environment that is out there and providing funds are sitting with multiple loans. Now, once you sit with multiple loans, you start juggling. So you start evergreening. And then you have got credit card debt, so you fiddle with that. So I think there are so many ways in which the borrower is fiddling that the bank or the intermediary is not able to realize this. Okay, let me also add that as a risk layer, because now there is an intermediary who is originating that loan for a set of banks. So you are adding another layer of what I would call, it becomes invisible to the final lender as to what is the embedded risk in the product or in the borrower. So there are a whole lot of great things that are happening here.
Let me ask this question on behalf of our viewers and for those who want to understand from your understanding of what is the next for the banking sector. In this decade, sir, who has the right to win in the banking sector?
Yeah, it's very simply three things. One is somebody who creates that trust in the minds of your counterparty, your customer, who provides the customer the best convenience, and that will come through technology. I'll give you a small anecdote, Nico. This goes back 25 years when we had a brand which was just being built. I say it was not a retail brand. But we had started introducing technology, ATMs, net banking, that. And within a span of 2 years, from 90% transactions in the bank happening at a branch, 90% had moved to either the ATM or... And we used to run, what do we call, customer understanding of what we are doing and our brand and things like that, regular basis, monthly. And I was amazed that very soon, the key number one, I would say, scoring point was convenience. Second was brand.
Okay.
And brand, I attach trust to brand, which I would never in my life at that point of time have imagined that somebody will say for a bank, convenience is more important than trust. And you're seeing that all over again now. The UPI payment has been, the people who ran with the UPI payment are the fintechs, who you normally will say, I do not trust, but convenience was king. And you rode that wagon as it were. And they are now doing things. So slowly, I think this trust is going to be balanced by convenience as you go along to a larger and larger manner. So banks will need to learn that convenience is king, trust closely follows, and we play it out. And anybody who can manage this in an appropriate manner is going to be the winner.
What's the third point? So convenience, brand, and what's the third point?
The third is execution. Execution. So you may have financial sector players who with ability to do this, but do not have the execution ability, and for various reasons. They either do not have the people, nor the will, or a combination of the two. I think that will slowly erode your strengths as you go along.
One looks at the pecking order of the top 5 banks in India. I'm going to take the clock forward. 5 years from now, do you think the pecking order could change because simply what these 5 banks are doing?
No, I won't name any bank, but the order could change based on their ability to use technology and the heart they have to use technology.
But a 5 could become 2 or a 2 could become 1. But do you see that the top 5 banks in India, a new bank could become an entrant?
I would think that it is very difficult for a new bank to come in there because there's a whole lot of base, foundation built up. And if I look at it anywhere in the world, the last 2 turns were tiger economies and before that Japan. The incumbent banks became stronger and stronger. So the top 5 banks certainly will remain strong. There will be a good base of other banks. But the base that the top 5 banks have built is very difficult to replicate. And also one has to remember that these banks and the base that has been built provide the regulator comfort.
Yes.
To build and grow, provide support to an economy which is going to grow, I would think we're going to grow nearer 10%. So, my mantra there is 7.5% is a given, and another 30% because of the digital economy. So you add that, you are nearer 9. And now I can confidently say that you can add another 0.5% because India is going to be a domestic tourism-led country as we go along.
How large do you think tourism could be for India? Because if you're talking about GDP and multiplier, Mr. Kamath, then we are looking at a multiplier of 1% kicking in on a $4 trillion base.
Yeah. So what we are looking at is I'm looking at 10% growth overall. You can then parse it in whichever way. I call it existing, then I lay on that digital, and then I lay on that new. New is all the momentum that we are seeing. And my view is that if you go into rural India, every time I've gone into rural India, you see new rural India. Rural, semi-urban, tier 2, tier 3 cities. The new India that I see. Whenever I've gone, I've not traveled that much. So I'm trying to figure out why people are saying the rural economy is not kicking in. Something is not right in that statement, and we'll have to figure out.
So I'm just going to take the clock back and maybe not extend the appointment beyond 2 questions. You'd made this point, I think, in 2021 that the fintech is here to stay, but fintech valuations will not stay. And then interest rates went higher, fintech went through a funding winter. What is your take on the fintech world?
It's not changed.
Valuations are still
Fintech
high?
is definitely they have built great platforms, but I think the basic mistake is the VCs thought that they could get it to a price which they thought is right. I wouldn't say anything more, and then leave it to the marketplace, the public marketplace. The public marketplace, at least in this country, has turned out to be much smarter than that. So unless you show a solid bottom line or visibility on the bottom line, you are not likely to get funding. Until that is changed, winter will probably ease, but it won't be a summer in full bloom or a spring in full bloom.
At 77, you're incubating a new business, chairman of Geo Financial Services. They say that after 69, Indians should retire, but you've taken a challenge of a new innings. What keeps you going, sir, at 77?
So at 68, 69, I had one challenge, to go into a different country and work with 5 different cultures and 5 different countries to set up an institution. So in a way, I think it got conditioned. But I think it's just the excitement of building or contributing to this new India. I don't think anybody would have an opportunity to go through a country which is going to grow at 10% for 25 years. And even if I have 5 years of joy in working on that, I think that drives me through. So I have to be fit, I have to be alert, my mind has to be like that 25-year-old. Honestly, I benchmark my mind with a 25-year-old. So if I can't understand what he's understanding, then I'm back to my real age. So at every moment, I'm trying to see where should I be in terms of that 25-year-old recruit who's sitting out in the office.
And what do you do? What is your day like so that you make sure that you think like a 25-year-old?
I try to read everything that would keep me in that ballpark, particularly on technology, trends, what is happening, how to use and so on. And then there are well-wishers who drop hints. So one of the biggest hints that I got was a few years back when Vishal Sikka mentioned to me that AI is, the price performance is doubling every 3.4 months.
Okay.
And prior to that, the benchmark was Moore's law, where you could say price performance squared every 2 years. Now, squared every 2 years against 3.4 years, 3.4 months doubling. So you take it through the year, that's 10x increase in a year. So you can imagine what the performance is improving or the price is dropping for the same given performance. Now, if that is happening, you have to look around and see what's happening in your own organization. Are you seeing the benefits of that? And this is before Gen AI. And now comes Gen AI in terms of what you could do. So I think it's going to be a great fun. So basically, I tell every youngster that you have to be retrained when you come in. You have to be exposed to these new things. If you are, good. Otherwise, you have to be.
So when you're not reading and when you're not working, are you watching ET now that time?
Oh yes. Oh yes, I'm watching. So I'll tell you something. I start my day watching ET now.
Okay.
So, and that's the pre-market. So when you and your team come on screen before the market, that's the most productive TV watch that I have. Once the market opens, then I start getting ready to get to office, so that by 11 I am here. But up to that point in time, I'm watching ET now. And then here I would watch off and on. If I don't have a meeting, I will watch.
Team ET now is sure thrilled to hear that ET now forms a part of Mr. Kamat's daily routine. But interesting conversation there, talking a little bit about the outlook when it comes to banks, how they need to have a healthy mix of unsecured lending and how high margins in banks are transitionary, according to him. A quick check-in, and as of now, the market's at 21,297. Karnataka Bank, by the way, that stock continues to remain in the spotlight post its numbers. And of course, we're continuing to track what Axis Bank is up to. Top Nifty loser, but paired off some of those earlier losses. Let's get a move on then, and the government is finalizing the modalities of the PM Surya scheme, and REC will be playing the role of the overall program implementation agency. That's the word coming in from the Chairman Managing Director. Let's listen into this exclusive conversation with ET now.
Ministry of New and Renewable Energy is working on the this PM Suryodaya scheme. They'll be coming with a comprehensive guideline. The subsidy structure is also being planned to be revised, particularly in the lower segment, from 1 kilowatt to 3 kilowatt. The subsidy amount may be higher, and the subsidy amount is applicable from up to 10 kilowatt category. With the renewed focus, and this rooftop solar mission would be taken in a mission mode now. And Honorable Prime Minister has already announced that we'll be targeting 1 crore household to be covered in 1 year. And overall, by the year 2026, we have to target installation of 40 gigawatt capacity from the rooftop solar. And as per the mandate given by Ministry of New and Renewable Energy, REC is going to play the role of overall program implementation agency.
So what would be the overall capital allocation, because the government will be providing subsidy amount, as you mentioned, even below 3 kilowatt capacity. So what would be the overall fund size?
Say for 1 megawatt capacity, the total cost comes around 5 to 6 crore. So if you are targeting 40,000 megawatt capacity from rooftop solar, total financing required would be to the tune of about 2 lakh to 2 lakh 40,000 crore. The subsidy amount is there for capacity up to 10 kilowatt. The subsidy amount for the initial category from 1 to 3 kilowatt is say 40%, and for higher category from 3 kilowatt to 10 kilowatt it is about 20%. The modalities are being reworked by the Ministry of Renewable Energy, but subsidy will be available for lower category up to 10 kilowatt capacity. But other than this, there will be government buildings, the commercial establishment, there also the central public sector undertakings have been identified to carry out this rooftop solar work in a mission mode as in a RESCO model.
REC is diversifying its portfolio as mandated by the government. Can you give some details about that particular sector which is on priority in your list, where you are planning to fund more and trying to get more business from there?
Yeah, for Government of India has allowed us to diversify into non-power infrastructure and logistics. We have started financing the refineries, the electromechanical components of the refinery projects. We have already funded HPCL project, and we are in the process of finalizing financing for IOCL refinery. Other than refineries, we are also targeting the electromechanical components for the steel power plant. One project we already taken up in the state of Odisha. Other than that, we are targeting the railway projects. We are also targeting road and highway projects, airports, metro, super specialty hospital, IT infrastructure, data center. These are the sectors wherever revenue cash flow is assured and the asset quality is good, we'll be venturing into this financing of this non-power infrastructure and logistics.
Okay, that's the take coming in from the REC chairman. And you know, that stock of course is one which is holding up quite smartly. In fact, let's just bring up the intraday graph, because I think you are seeing almost a 6.5% gain now. 462 is where that stock is currently in trade. But continue to track earnings in L&T Finance Holdings. Let me welcome on board the newly appointed MD and CEO Sudipta Roy, joining in on the show right now. Sudipta, hi, morning, good to have you on ET now. Your retail growth for the quarter came in higher than the target that you had set out. That's your Lakshya 2026 target, right? For the third consecutive quarter. Which segments are particularly contributing, and is this the sustainable figure going ahead?
all of the segments actually are growing satisfactorily. It's not that one single segment is outgrowing any other segment. And if you would know that our main lines of business are our rural business finance vertical, our urban finance vertical, as well as our farmer finance vertical. So each of these verticals have been growing satisfactorily over the past couple of quarters. And as you know, in this particular quarter, there is the added benefit of having a festive period, wherein certain urban products like two-wheelers or tractors have a natural tendency for customer purchase. So basis that, all our businesses have done reasonably satisfactorily growth, and we are sort of hopeful of continuing this great growth trajectory going forward.
But going into Q4, which is generally a strong quarter for lenders, do you expect to sustain this kind of momentum? And is it fair to, assume that you will end the year with a retail growth of over 30% at least?
As far as our Lakshya target guidelines, we have guided that we will grow at around 25%. So we remain committed to that particular guidance that we have given in our Lakshya targets. As of now, I would not like to give sort of any specific number guidance for Q4, but we expect that we will continue on our trajectory that we have guided in our Lakshya targets of 25% odd.
Right. Mr. Roy, morning. Could you provide any sort of a timeline in terms of the rundown of the wholesale book? When can the overall loan book start posting strong growth?
So as you know that we have been sort of running down our wholesale book and paring down our wholesale book, and currently our wholesale book stands at about 7,000 crores, which is a degrowth of about 1,300 crores from what was there in Q2 FY24. And so we remain sort of committed on reducing our wholesale book, but obviously maybe the speed at which the sort of the degrowth has happened over the last couple of quarters, there might be some tempering in that, because currently the most of the assets that we have in our current wholesale book are scattered assets. And on the other side, we are also working on increasing our retail disbursements as well as our retail book. You would have noticed from the overall numbers that our retail book has added in terms of book size this quarter compared to the previous quarter. And that growth, as we keep on sharpening our retail disbursement engine and our execution engines, that growth will keep on sharpening. So you will see the book growing reasonably strongly hereafter. And we are committed on sort of paring down our wholesale book and transforming to a largely, a retail financial services company. And that sort of transition will take the next couple of quarters to complete.
Right, and your NII as well is higher than what the street was anticipating, right? Help us understand what's played out here, whether there was any repricing of yields, and how have you managed to, how have you managed your cost of borrowings?
See, our sort of the composition of our products, if you see overall, in the previous quarters, we have been degrowing our wholesale book, and we have been moving more and more retail. Right now, if you see, as far as we have given our guidance, we're almost 91% retail book size now. So obviously, wholesale has lower yields and retail obviously has much higher yields. And if you look at the composition of portfolio, the rural business finance portfolio has normally is a high yield business. The two-wheeler business is also normally a high yield business. So given the composition of the rural products, which are naturally in high yield, we have been able to maintain our NIMs, and we expect that we should be able to. And if you look at our cost of funds, and which we have given in our analyst presentation also, our cost of funds has remained relatively stable, has moved by only 2 basis points compared to last quarter. So that's how we have been able to maintain more or less steady state NIMs.
Sure, but given the fact that banks are rationing credit a bit, any specific impact you foresee on the cost of borrowings for yourself in the near term? And going ahead, beyond let's say 2-3 quarters, when the rate cycle does turn, how's the cost of fund trajectory expected to move for you?
So, as we are all aware that RBI has been sort of nudging the entire retail financial industry to be cautious on the consumer credit side, and obviously has increased the RWAs on part of the unsecured credit. We have sort of calculated what might be the impact on our cost of borrowing going forward, and we have our guidance is that we'll probably see probably a 10 to 12 basis point increase in our cost of borrowing, other things remaining constant over the next 1 year period. So in terms of the impact, yes, there is some impact, but I do not, consider a 10 to 12 basis point impact very significant. And as and when the rate cycle sort of starts adjusting again, maybe that might give us some breathing space in the entire sort of cost of borrowing space. So going forward, we expect that at least for the next 2 to 3 quarters, maybe the cost of borrowing sort of remain within from our current go up max about 10 to 12 basis points from what our current cost of borrowings are. And depending upon whatever RBI's rate cycle starts happening, that's a discussion at that particular point in time.
Right, and you have also taken over from the reins of Mr. Dubhashi. What are some of the targets that you have set for yourself, or how would the company really evolve under your leadership?
So as you see, we are transitioning to a completely transitioning to a retail finance company, and what we call define at fintech at scale, and NBFC, which in sort of underpinning that we define as fintech at scale. So as part of that, and we have sort of set ourselves an ambitious goal of sort of transformation while following the Lakshya goals on what we call 5 pillars of execution. Firstly, obviously, increase the customer acquisition velocity that we have. So over quarter on quarter, we'll try to put more new customers into the fold. The second thing that we will try to do is sort of improve our credit metrics or improve our credit quality, our quality of credit delivery is what we will try to do. And for that, we are building a new advanced credit engine that not only ingests the bureau data, but also looks at account aggregate data and also looks at sort of what we call orthogonal signals or lifestyle or sort of trade signals available in the market. So we are also working on sort of building a futuristic digital architecture. We are working on sort of improving the customer journeys, especially on all our digital platforms, and making sure that the underlying technology is far more improved to take in the increased flow of customer acquisition. On a fourth pillar is what we are looking at increasing our brand visibility. We have sort of hired a new chief marketing officer, and you will be seeing us present in the market in terms of brand visibility over the next couple of quarters in a significant way. And last but not the least, we are investing in our capability building in the technology area, in the trade and risk area, as well as in the data analytics and
Sure. So given the completion of, the merger with subsidiaries, your move towards realization, your Lakshya 2026 targets, how differently would your ROA and ROE look for the couple of years down the line?
So, we have guided on ROAs. We have our guidance on ROA as per our Lakshya strategy is 2.8 to 3%. And now post our merger, wherein we have merged L&T Finance and LTICL, L&T Infrastructure Credit Limited with LTFH, and now it is one single entity. Our guidance had been that, we will move into a 2.8% to 3% ROA trajectory. So we expect that we will continue on the trajectory. Currently, we are at about 2.53% consolidated ROA, and ROA improvement trajectory will continue. So we expect that around exit FY26, we should be somewhere near the 3% ROA levels. So that is what we would guide. On the ROE side, obviously, we would like to move towards, as an organization, will move towards a 15% ROE. So we are hoping that, during that course of time, around FY26, when we sort of hit the 3% ROA level, we would be more or less near that number as well.
Okay, so a good set number coming in from L&T Finance, and that's the management talking about the outlook going forward. Thanks so much for making time and speaking with us. Quickly taking stock of a few buzzers, IFCI is up around 16%, Carbon Random Universal is the other stock which is higher by 7%, South Indian Bank, REC, Indus Towers. These are some of the stocks which are gaining ground, while Karnataka continues to see acute pressure. That's down 10%, as well as Gravita India taking a knock of around 5%, while the index continues to hold quite steady. We have seen quite a bit of recovery from the start of the trading session to now. So 21,360 at the index level. Time now to slip into a very short break. Don't go anywhere.